The world's most critical energy choke point is paralyzed. The United Arab Emirates has just fractured a 59-year alliance by walking away from OPEC. And within minutes of that announcement, global silver markets crashed nearly 3%. Welcome to the macro shift. I am Suri. In the last 48 hours, the geopolitical architecture of the Middle East has been fundamentally rewritten. An unprecedented combination of a US-led naval blockade, a rejected Iranian peace proposal, and a rogue producer completely bypassing the Strait of Hormuz has sent Brent crude rocketing past $111 a barrel. The downstream economic effects are already triggering violent intraday sell-offs in precious metals. Today, we will unpack the data-driven reality behind the headlines, map the geopolitical chessboard, and project exactly how this week's events will dictate the charts for oil, gold, and silver. The structural foundations of global trade are cracking. Let us begin. To comprehend the current market shock, we must examine the catalyst. Effective May 1st, the UAE officially withdrew from the Organization of the Petroleum Exporting Countries. This decision was not impulsive. It is the culmination of a week where global energy markets realized the Strait of Hormuz will not reopen anytime soon. We are in the third month of a suspended crisis between the United States and Iran. Just days ago, Tehran submitted a 14-point peace proposal via Pakistan, offering a new framework for the strait. The U.S. administration immediately rejected it, with Washington declaring that Iran has not paid a significant enough price for its recent actions. This diplomatic deadlock leaves 20% of the global oil supply effectively trapped. For the UAE, a nation with a heavily capitalized production capacity of 4.8 million barrels per day, being restricted to an OPEC quota of 3.2 million, while crude breaches $100, became mathematically unacceptable. They have opted to monetize their reserves immediately. The remaining OPEC Plus members are holding emergency meetings today, scrambling to stabilize an alliance that just lost a crucial shock absorber. But the UAE's exit is only half the equation. To understand why Abu Dhabi possessed the leverage to abandon Riyadh and ignore the Iranian blockade entirely, you have to look at a single piece of infrastructure that renders the Strait of Hormuz entirely irrelevant for the UAE. The data on this bypass route will change how you view the map forever. Watch closely. That pipeline gives the UAE direct access to the Gulf of Oman, effectively neutralizing the Iranian threat to their primary revenue stream. This is the geopolitical chessboard in motion. Washington is betting that a sustained naval blockade will crush Iranian oil revenues, forcing their storage tanks to maximum capacity. In response, Iran maintains its grip on the strait, squeezing global inventory and punishing nations reliant on maritime imports. India, operating with severe crude requirements, is already feeling the localized squeeze, though tracking data from this weekend showed a rare India-linked LPG tanker, the Sarv Shakti, navigating past the blockade. This highlights the selective permeability of the strait based on regional alliances. China is watching this friction intensely as the US Treasury threatens secondary sanctions on financial institutions processing any lingering Iranian crude sales. Meanwhile, Russia and Saudi Arabia find themselves anchored to a dysfunctional cartel. Without the UAE's compliance, enforcing production cuts to maintain artificial price floors will become significantly harder. However, in the immediate time frame, the fear of an expanding conflict overrides the UAE's added supply. This localized energy inflation directly paralyzes central banks. The Federal Reserve cannot justify rate cuts when energy inputs are skyrocketing. This dynamic is wreaking havoc on precious metals. We mapped the exact correlation between the Hormuz closure and the recent intraday plunge in silver. The divergence is striking. I will show you the exact chart. The data reveals a counterintuitive reality for retail investors. Historically, geopolitical conflict triggers a flight to safety, boosting precious metals. But the old rules no longer apply. Gold recently fell over 2%, retreating to the $4,570 range, while silver took a more violent hit, dragging the gold-to-silver ratio up to 63. The mechanism behind this sell-off is rooted entirely in inflation. WTI crude, holding above $100, virtually guarantees that the consumer price index will remain sticky, well above central bank targets. Consequently, the Federal Reserve is trapped. They cannot lower interest rates. High interest rates strengthen the US dollar and increase the opportunity cost of holding non-yielding assets like gold. For silver, the impact is compounded. Silver is inherently an industrial metal. Surging crude oil increases industrial manufacturing and global transport costs, acting as a massive economic headwind that depresses silver demand forecasts. While the retail market reacts to the immediate shock of the OPEC fracture by liquidating silver positions, institutional money is looking at physical supply. The macroeconomic fundamentals have not disappeared. They are simply being temporarily suppressed by a hawkish interest rate environment. To understand exactly where the floor is for these commodities over the next 72 hours, we must analyze the structural deficit facing the market. The technicals leave no room for ambiguity. Here are the key supply levels. Looking toward tomorrow's trading sessions, the impact of these converging geopolitical forces will dictate distinct trajectories for our core charts. For oil, the floor remains heavily supported by the immediate risk premium. As long as the US maintains its blockade and Iran refuses to concede its strategic position in the Strait, Brent crude will experience violent upward volatility on any news of kinetic escalation. However, the UAE's exit introduces a structural bearish element. As Abu Dhabi scales toward its 5 million barrel per day capacity, that unquoted supply will eventually saturate the market, creating a slow, downward drag on prices over the coming months. For gold, expect continued consolidation. Until the energy-driven inflation narrative breaks and the Federal Reserve definitively pivots on rates, gold will struggle to break its current resistance, acting as a hostage to U.S. monetary policy rather than a safe haven. Silver will remain the most volatile asset on the board. It will continue to suffer in the short term from high industrial input costs, but the massive 46 million ounce physical deficit provides a hard fundamental floor against total collapse. The macro landscape is shifting faster than the algorithms can price it in. Our proprietary data models are already tracking the secondary supply chain bottlenecks emerging from this Middle Eastern paralysis. The next major logistical fracture will not be in the Gulf. Make sure you are subscribed to the Macro Shift because next time we are exposing the data behind the Pacific choke point. Until then, stay grounded in the data.